What's up, everyone? It's Caddy with Money Vesting. So a green week for the markets, very much back and forth. In fact, we filled the gap. We came down, validated that support from yesterday and the day before, and then the markets rallied back higher to close green, but barely. The Nasdaq was up a little bit over 30 basis points. We got the S&P 500 up over 0.5%, and the Dow Jones also rallying higher a little bit over 41 basis points as the 10-year yields continues to decline here, and it was down on the week a little bit over 1.6%. In fact, it did break down below 3.3% very briefly and then rallied back up to close out the day, still down 1.5%, trading just a little bit under 3.4%. So I hope you guys enjoyed this video and find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. The link to our Discord and Patreon is going to be down below. If you're interested in joining us, there is a 16% annual discount that is available till the end of this month, and you get access to all the buy and sell alerts, options alerts, trade ideas, swing trading ideas, and of course, access to all the private videos and tutorials and lectures as well. So there's going to be the link down in the description below. So Bank of America came out with a report today, pretty much suggesting the next bubble and saying that investors should sell stocks rather than buy them after the last rate hike. This right here was the headline. And as you can see, Bank of America identifies the next bubble and says investors should sell stocks rather than buy them after the last rate hike. And they pretty much mentioned, and this is a team run by Michael Hartnett, says that money market funds are the new hot asset. They point out that assets under management for money market funds has now exceeded to $5.1 trillion, which is a record, and that's up $300 billion in the past 4 weeks alone. And they also counted the biggest weekly flows to cash since March 2020. The biggest 6-week inflow to treasuries ever, literally ever, and the largest weekly outflow from investment grade bonds since October 2022. So what we're really seeing is obviously a big shift in liquidity. So as we mentioned in my previous videos, as a lot of the regional banks go under a lot of pressure, go under a lot of stress, we are seeing investors and just consumers take money out and put it into either treasuries or money market funds or even safety haven wise big tech. And those are some of the beneficiaries. We talked about, where is liquidity going, right? Where is the liquidity coming out of and where is it going? Because we do focus very much on liquidity on this channel. And as you'll see, the biggest 6-week inflow to treasuries ever, the biggest inflows into money market funds since March 2020. So we are seeing a lot of investors move to cash as this contagion fear continues to play on, as we continue to see more and more banks under a lot of stress. There's not really any safety anywhere at the moment. I mean, except for some of the largest banks in the US. Other than that, there's a lot of brokerages, small, medium-sized businesses, community banks. A lot of them are still dealing with the liquidity problems, still dealing with a lot of the pressure from the financial system. So that's where we have moved to. But I could also argue that this is actually even more reason to be bullish about stocks, because as investors move away from equities, away from corporate bonds, over to money market fund assets and treasuries, well, eventually that money is going to rotate back into equities at some point in the future. So do you want to be positioned into equities now, or do you want to be positioned in equities maybe later when this money is already rotated back into where it was in the first place? So again, it's all about perspective, and they're suggesting that the money market funds are the new hot asset. I could argue otherwise, that I think it's much better to be looking at deals in the equity markets, and you can kind of position yourself prior to this money rotating back, because $5.1 trillion is a record for money market funds. So something to consider. The last 2 times money market fund assets surged in 2008 and 2020, the Federal Reserve slashed interest rates. Hartnett is fond of saying the markets stop panicking when the central banks start panicking. And he noted that the surge in emergency Fed discount window borrowing has historically occurred around a big stock market low. And there is one difference this time, that inflation is a reality, and that the labor markets, not just in the US, but other industrialized nations, remains exceptionally strong. And the Bank of America team counted 46 interest rate hikes this year, including the Swiss National Bank after its rescue of Credit Suisse last week. History, according to BofA team, says to sell the last interest rate hike. Credit and stock markets are too greedy for rate cuts, not fearful enough of recession. So that is something that I do agree with. Okay, there's one thing that I do agree with, a report with the statement here in this report. That's this: the credit and the stock markets are too greedy for rate cuts, not fearful enough of a recession. And I think we've seen that firsthand. The markets right now pricing in with the Fed funds futures 9 rate hikes, 8 to 9 on my last count. Like literally as I'm counting, 8 on my last count. I think one of them was 50 basis points. It might have changed, but last time I checked, 8 rate hikes were priced in. That's 200 basis points, 2% for us to come down to. And the market's also pricing in a pause in the next meeting, not a rate hike. So we're in very dangerous grounds. Our expectations for QE are incredibly high, and not there's not enough fear of a recession. Unfortunately, at least not what the market's pricing in. Um, and after all, when the banks borrow with the Fed in an emergency, they tighten lending standards, which in turn results in less lending. That leads to small business optimism, which eventually cracks the labor market as well. So I do agree with that statement where I do think the stock market and the credit markets are too greedy for rate cuts. 8 rate cuts is quite a lot, and the markets are not pricing in appropriately of what could be the situation maybe 6 or 12 months from now with respect to a recession. Now, Deutsche Bank is not the next Credit Suisse, analyst says, in a panic spread. And the emergency rescue Credit Suisse by UBS in the wake of the collapse of the US-based Silicon Valley Bank has triggered contagion concern among investors. And this was deepened by further monetary policy tightening from the US and the Federal Reserve on Wednesday. And Deutsche Bank underwent a multi-billion euro restructure in recent years aimed at reducing costs and improving profitability. And Deutsche Bank recorded an annual net income of 5 billion euros, or 5.4 billion US dollars in 2022, up from 159% year over year. And there's also, again, analysts saying that their CET1 capital ratio is a measure of bank solvency, came in at 13.4% at the end of 2022, while its liquidity coverage ratio was 142%, and its net stable funding ratio stood at 119%. These figures would not indicate that there is any cause for concern about the bank's solvency or liquidity position. So that's what they're talking about. So German Chancellor Olaf Scholz told a news conference in Brussels on Friday that Deutsche Bank had, quote, thoroughly reorganized and modernized its business model and is a very profitable bank, and there is no basis to speculate about its future. Now, again, banks are quite dynamic, right? Things can change and flip on a dime, right? Because of the fact that they own so many derivatives, they own so many treasury securities, they own so many assets, and there's so much deposit base and liabilities and so many different really complex instruments. There's never going to be complete oversight on risk. That's just how banks work, right? They create these complex products and then they get into trouble with their own complex products, right? We've seen that happen all throughout history. Of course, 0708 was the prime example of creating all of these mortgage-backed securities and subprime loans and kind of pooling them together into these assets that can be sold to investors. And when the bottom line foundation defaults, which is the borrower itself, because of really poor credit scores and literally no jobs, then the entire system fails. And that's one of the things, is that whatever the banks tell about their own banks has to be taken with a grain of salt, right? Just because their capital ratios are good today doesn't mean it's going to stay good for the next several quarters or the next 1 month. So yes, it's good that Deutsche Bank fears are going to start to de-escalate now, and we have seen the credit default swaps, skyrocket substantially because there's fears about Deutsche Bank also not being able to meet its credit obligations, debt obligations, and possibly there's going to be some insolvency issues. But just want to make sure that just because somebody's telling you the bank is safe doesn't necessarily mean that it's safe, right? Just because Jim Cramer tells you that Charles Schwab is a great bank, or Silicon Valley Bank is one of the best banks, or Signature is the one to buy. I mean, of course, we know what happened, right? I mean, over time, these banks keep deteriorating. If the banks, a simple thing also I want you to understand is if the bank was so good, why is it that their stock price looks like this? Why is it that they have never been able to recover from the financial crisis, right? It's down another 3% today, but why does it look like this? They've just been on a consistent downtrend. And this is one of the main things that I teach in my technical analysis course, and that is that you can look at the company's performance without even having to look at it if you simply look at the technical chart, right? A very strong quality company performing really well, the stock price would never look like this. It would never look like a downtrending channel of lower highs and lower lows. So I'm just saying that yes, they could be in a very good position today. They could have good capital ratios, but don't take your eye off of what could be the main issue. And this is a Mark Twain quote that I really, really like. And he says, "It ain't what you don't know that gets you in trouble. It's what you know for sure that just ain't so." right? So it's actually a very cool quote from Mark Twain. He comes up with, of course, with the best quotes that we've ever heard. But I think there's just so much truth to that. Sometimes we know something for sure, but it's just not a reality. We kind of force ourselves to believe that because that's what we want to believe, right? And I think it's very appropriate to the current market environment. And sometimes you can think, and Federal Reserve kind of went through the same process, is that they looked at Silicon Valley Bank, they knew it was it was kind of like in that trouble, but they just never enforced on those regulations, on those laws, right? So let me know your thoughts down in the comment section below with Deutsche Bank, and Deutsche Bank is definitely going to be on the radar. I'm going to keep a close eye on it, and of course some of the other banks as well. I think Charles Schwab was also on the news today, but this is what the markets look like. We saw real estate pushing higher, utilities also rallying quite a bit with consumer defensives on the move, and we had Microsoft, Apple, Meta pushing up. Nvidia for the first time in I think an eternity finally starting to drop here 1.5%. We are very grateful for you, Nvidia. We're very, very grateful for you to pull back 1.5%. AMD down over 2.3%. Also very grateful for AMD to really listen to us and start to come down a little bit. Intel was still up, financials were still down. This right here was the entire market. So again, semiconductors really hurting on the day today, coming down, and utilities, real estate, consumer defensive, healthcare, all of them pushing higher. And we pretty much had most stocks, most sectors push up, except for consumer cyclicals that was down substantially. And over the last 1 week, utilities and real estate are the only two sectors that are selling off. And over the last 1 month, comm services and technology pushing higher really well. Everything else is straight up down. So lean hogs, wheat, orange juice, coffee, soybean oil, corn, oats, everything pushing higher with copper prices, palladium, VIX selling off. We've got Bitcoin back over 27,500, coming down a little bit, 2.6%. Ethereum a little bit over $1,700 at the moment. So volatility on the day, very, very flat, just down close to 4% here. Crude oil prices are also getting rejected at that resistance at low 70s, so $71, $72 per barrel. And we got a support setting roughly at $65, $66 per barrel for crude oil at the moment. Bitcoin also getting a rejection at 28,200. This is a very strong resistance, seems like, for BTC. And of course for Ethereum, we're also getting a little bit of consolidation here. So red, green, we're just going sideways with a support level sitting right here at 17 at 38, 1740 levels for Ethereum. Yields have continued to fall over. This is a very important chart to focus on, as we are seeing both the 10-year and the 2-year yields drop. The 2-year is falling much faster than the 10-year, and as a result, we are seeing this inversion in the yield curve once again start to normalize. So this will most likely turn positive very soon if the yields continue to drop, but the gap between the 10 and the 2-year continues to narrow down and eventually inverse once again. This will start to turn positive, where we will see the stabilization in the markets, where the 10-year yield will be yielding more than the 2-year once again. And this right here is going to be the 10-year versus 3-month, which is surprisingly still pretty wide, and down to negative 128 basis points. So 3-month is not moving down, it's staying sideways. And we're seeing the 10-year yield move down further. So that gap is widening between 3-month and 10-year, but that gap is narrowing between 10-year and 2-year, because 2 years moving down faster than the 10 years. Quite an interesting bond market that we have in front of us. Talking about the S&P 500 now. And again, we did see a little bit of a momentum this week. So markets were green. S&P was at 1.3, 1.4%. But what we have really seen is a lot of consolidation sideways. 2 red days and a green day, then red day and then green. Resistance is going to stay put here. That's the level that we are watching, sitting roughly at 4,100. We got a support at 3,774. So this week, again, despite the Fed meeting, despite the SEP and all the stuff that's been coming out, the markets were very flat and lots of consolidation. And I think that's really what's been the theme for the stock market in 2023, is that it's mostly macro driven. We're not seeing a lot of moves upside or downside. Instead, we're just seeing a lot of sideways. I think it's been more of a kangaroo market in the last several weeks here, because if you take notice where we're coming from since December, sold off, pushed higher, sold off, pushed higher. It's just like jumping back and forth in between that range and not really doing much. So it kind of looks like we're doing a lot, but we're not really making any progress. Talking about the NASDAQ, same thing, just pushing higher here. And we've really seen a lot of consolidation for the NASDAQ as well. And You'll notice that we actually once again sold off, pushed higher, sold off, pushed higher, sold off, pushed higher. Just seems like a lot of sideways action instead of actually making a directional move to the upside or the downside. Of course, we do have, within that consolidation, we do have some pretty strong moves here. I mean, Nasdaq pushing up 20% and, dropping over here about 11-12%. Those are pretty sizable moves, but we haven't really made any net progress in the last several months since September of last year. So resistance is going to stay put at 12,280. That's going to be the level to watch. And we got a support here, of course, with the lower high from January of 22 and all the way down to 10,000 is also going to be that support level to pay attention to for the Nasdaq. Talking about Apple, and Apple here also pushing higher. So once again, validating that support at 157. So we talked about this being a very strong support for Apple, and low for the day was 157.85. And that is going to be that support level to pay attention to for Apple. Of course, next target and that next resistance is going to be 177. Talking about Amazon is going to be down about 0.5%, trading a little bit under $100 per share. This is going to be that lower high for us to watch. And again, Amazon also lots of consolidation, just kind of going sideways, in this kangaroo type market. Not really moving much, but getting rejected here, getting supported here, and we're just trading in that range. Talking about PayPal, and PayPal here pushing higher 1.8%. So again, it continues to trade in this downtrending sort of descending triangle. We're getting rejected by this downtrending line, and we've got a support validation over here at around $67. So we're seeing a lot of lower highs being formed. So that's going to be that support level to watch. And of course, lower high here as we continue to fill into this downtrending channel, then it's going to be quite interesting. What happens with PayPal? Do we get a breakout? Or do we actually get a breakdown? It's quite difficult to actually predict exactly what's going to happen because most of the times descending triangles are bearish patterns to begin with. But I have seen in the past that patterns have broken out from this descending triangle as a lot of buyers have stepped in. So eventually we'll see what ends up happening. Square here recovering a little bit. So again, a green candle and validating this support level that we talked about at $59 per share. So that's exactly where it's kind of settling in now. And RSI MACD a little bit on the oversold side. We got a big gap to fill on the upside. $83 to $89 is going to be that resistance. And again, support level is going to stay put at 59 to as low as $52 per share for Square moving forward. Talking a little bit about, NVIDIA. So again, thank you, NVIDIA, for starting to pull back a little bit, 1.5%. But my target's still put at 292, so that's still going to be that resistance level to watch for NVIDIA. That's going to be this level right here and starting to pull right back down. RSI MACD very, very overbought. This right here is going to be that gap that it needs to fill eventually. And right now, of course, we're kind of having that below the top of rally for NVIDIA at the moment. Advanced Micro Devices also getting up to that resistance at $102, $103. So this right here is going to be that level to watch for Advanced Micro Devices. We're kind of tapping onto this higher high. And again, getting a little bit on the RSI and the MACD overbought side here for those two indicators. So I wouldn't be surprised if we do start to see a bit of a pullback going into next week for those two stocks, both NVIDIA and AMD. Meta continues to stabilize at $206. So again, very strong uptrend, one of the best performing stocks in the last 6 months. Support level is going to stay put right over here at around $198, close to $200. And the next resistance and target is going to be at $222. So this right here is going to be that level to watch. We got a big gap to fill for Meta over here. That's going to be a huge gap that we need to fill in for Meta platforms moving forward. Talking about Netflix here, Netflix also continues to push higher. And again, this was the entire analysis that we had, up another 2.5%. And continuing on this uptrend, RSI and MACD was oversold, so it's not a surprise that we're seeing a lot of momentum back up for Netflix. And the next resistance really is going to be all the way to 370, 375, around those levels. So this is going to be that level to watch for Netflix moving forward. Talking about Google, and Google here continues to kind of stabilize a little bit, not really down as much, but resistance is going to stay put at 109. So this is the big target that Google needs to break out of next. And of course, right now we're starting to break outside of this downtrend, which is very good. But we need to see that continuation and that momentum for Google. However, the RSI and the MACD are also a little bit on the overbought side. So that is something to definitely be paying attention to, because could represent a bit of a pullback, and support level is going to stay put at $101, $102 per share. Microsoft, on the other hand, is also pushing higher, up over 1%. And this is the next target that we have talked about in our previous videos. That's going to be sitting roughly at 292, 293. So this is the resistance. But again, RSI MACD a little bit on the overbought side, similar to what we see for Google. So would be very, very careful with this stock moving forward as well. And finally, Shopify, lots of consolidation, down a little bit over 1.77%, continues to validate these higher lows at the moment. And the next resistance really is going to be all the way up to $54, $55. We do have a gap to fill for Shopify as well in the future, which is going to be somewhere between $47 and $50 per share. So hope you guys enjoyed this video and a complete update on the markets. It was quite an interesting week. We pretty much have been going sideways and a lot of consolidation. But that being said, I do still think the market it's possible the market's underscoring the possibility of a recession later this year, and at the same time is becoming overly optimistic about all the rate cuts that are priced in but not mentioned by the Federal Reserve or Jerome Powell. Things could change, but right now the market's absolutely optimistic about 8 cuts, if not more, eventually with respect to interest rates. So be careful out there. Have a great weekend. Hope you guys enjoyed this video. Found it helpful. If you did, make sure that you drop a like, subscribe to the channel. Link to our Discord and Patreon is going to be down below. As always, happy investing, and I'll see you all in the next video.